You can't always get what you want.
Long-term capital appreciation and income. If you think that's all investors actually want, you're kidding yourself. As it turns out, investors want a lot of things, many of which have nothing whatsoever to do with money.
Well, you might find you get what you need.
I'm Barry Ritholtz, and on today's edition of At the Money, we're going to discuss what investors really want. To help us unpack this and what it means for your portfolio, let's bring in Meir Statman, professor of finance at Santa Clara University. He is an award-winning expert on investor behavior and decision-making. His book, What Investors Really Want, has become a classic that explains what drives investors' behavior. So Professor, let's start with the basics. In your book, you explain investors are motivated not just by financial returns, but by expressive and emotional benefits. Explain what those are.
Well, yes, they are. So utilitarian benefits are those risk and especially returns that you just mentioned. But there are also expressive and emotional benefits. Now, for people in marketing, of course, this is so trivial. All products and services have utilitarian, expressive, and emotional benefits. Think about automobiles. Compare a Toyota to a BMW. Both cars will take you from home to work and back. But there is a difference, when you compare them, you can see that while they have the same utilitarian benefits, getting you from one place to another, driving a BMW is driving the ultimate driving machine. You say something to yourself and you say something to other people. And there is a zoom sense of pride when you drive it. I drive the Toyota. I say that when I get out of my Toyota in the parking lot, I lock it and move away fast so people will not see my car. But if I had the BMW, I would kind of linger, just making sure that people see me. The same applies to financial products. People in finance often regularly ignore that. Think about Bitcoin. Sure, people who buy Bitcoin buy it for the returns, high returns. But there is more to it, that is, if you are into Bitcoin, you say, I am young, at least young at heart. And you express yourself this way, and you get those emotional benefits, including perhaps primarily hope that you're going to strike it rich, that is the volatility of Bitcoin is really an advantage to those holding them because many consider it their retirement plan. So think about all other products, financial products and other products. All of them have those utilitarian, expressive, and emotional benefits, and it's important for us to identify them.
So investors always seem to be looking for a free lunch. They want bigger profits, but at the same time, they want to assume lower risks. You've described this as free lunch or no lunch. Tell us about the relationship between risk and reward.
I like to say that people want two things in life. One is to be rich, and the other is not to be poor. And those two battle inside us. And so, for one thing, it is smart to divide the portfolio instead of kind of by risk, to two segments. One for being rich, say in stocks, in options, maybe Bitcoin, and the other for not being poor in bonds, money market fund, and similar. So in this sense, you limit your losses, but you allow yourself some gain. If you are trying to do both of them together, it is really impossible, because it is impossible to invest in riskless stocks. But if you don't invest in risky things, in risky investments, you are not likely to accumulate enough for retirement unless you are a child of very wealthy parents who are also very generous to you. And so you just have to accept that you cannot beat the market, and don't make it an issue of beating the market. Make it an issue of what is it that you want in life and follow that route.
So we're talking about risk. We're talking about reward. How does this vary by age, by gender, by personality? Does it vary by country or culture, or is this pretty much the same for all people?
No, it varies. It varies by all of these. It is not a very strict rules. That is, there are men who are very risk averse and women who are not risk averse at all. But generally, women are more risk averse than men. So think, for example, of the following gamble. Suppose that I say, would you take a 50-50 gamble chance to either double the value of your portfolio or see it cut by 20%? Would you take that kind of gamble? If you are very risk averse, you would not. If you're less risk averse, you will. And you can vary the percentages to kind of get it more precisely calibrated. Well, I did that kind of question in 23 countries among students. And what I found was that in all of them, with no exception, women were less risk tolerant, more risk averse than men. And so that really is one of those things. Think about the issue of personality. There's a notion of the big five. Anxiousness, it's about conscientiousness. It's about being outgoing, open. What I find is that people who are conscientious are very good at saving, and they are not very good at taking risk. People who are extroverts are not as good at saving, but they are more willing to take risk. And so personality does matter. And culture matters. That is, if you think about two kinds of cultures that people talk about, being individualistic, as in the United States, or collectivistic, as in China, people are willing to take more risk, in fact, in China than in the United States. And if you ask yourself why, there are two possible answers. One is what is called the cushion hypothesis, that because China is collectivistic, people can rely on family. And so if you know that you can take risk on the upside, because if you fall on your face, you can expect your brothers and sisters and cousins and so on to come to your aid, whereas you cannot expect that generally in the United States, where at least from your brothers, you don't expect support. One of the interesting things is that when you have a brother who suddenly has sort of a major liquidity event, say he was part of a startup and now he is a multimillionaire, and you are still working as a regular Joe, you feel really envious. In China, it is different because you know that those millions of your rich brothers will support you if you fall on bad times. And so all of those things, we are all the same inside. We are all people. We are all normal. But culture, gender, personality, all matter.
So how can we perform postmortems on the financial decisions we made? How can we evaluate our process to make sure that we're making good decisions?
One thing is really to be able to step away from yourself, to step away from the bias introduced, say, by pride and regret, and assess your performance objectively. So, for example, keep a log of your gains and losses. Don't just keep them in your mind, because you're likely to keep track of your gains, but somehow push away your losses. Many people fail to realize losses because this allows them to think that those losses are not really losses. The other thing is to use science, that is not to reach general conclusions from very small samples, from experiences. I, for example, play an investment game with my students when I teach an investment class. And so I let them invest in whatever they want, and I just invest in the total stock market, the index fund. Now, they really want to draw very great conclusions from how well they did, and they say things like, next time I will not buy this stock. Of course, that stock went down. And I try to impress on them that the way they should do that is not just judge their performance or their portfolio. Look at the overall portfolio. And what you're going to find, I say, is that some people who had some elaborate logical strategies, in fact, ended up towards the bottom. Some people who worked on luck alone ended up on top. So the reason I invest in the total stock market is because I know something about the science of finance. I know the benefits of diversification. I know the dangers of judging from small samples.
So to wrap up, investors want more than just capital appreciation and income. We want to feel validated by our choices. We want to avoid regret, and we want to show off our status. But these non-financial factors can lead to decisions that may not be in our best interest. We need to be aware of this and avoid those poorly motivated, emotional decisions. I'm Barry Ritholtz, and this is Bloomberg's At the Money.